Hey guys, as I promised you, I'm going to reveal exactly how I plan to retire in the next 10 years and invest over $1 million and be financially free for the rest of my life starting in my 40s. Stay tuned. So as we begin here, I'm going to show you three very useful websites that help you plan your future in investing. Okay, the first one you can simply find by clicking on the link below. It's going to be from Bankrate, and this is the compound interest calculator. Now it's very simple enough. This one allows me to input my actual numbers, and it's different for everybody because everyone invests at different rates and different times. But this one allows you to personalize your own investing strategy. Now, how this is helpful is that there are many high yield savings account out there like Betterment and Wealthfront that offer like a very competitive high yield savings rate of around, I think, 5% nowadays. So for example, if you're going to enter your information in here and I'm just going to enter mine, you can follow along and do this on an extra tab while you're watching me. But currently, let's pretend I started from zero and we have no money, okay? And let's say we can save for the next, let's say you're saving for like semi-retirement. So you're going for like, let's say 15 years. Now, again, we can change this at will later. So we're just going to play around and enter return. And of course, the high yield savings competitive rate, I think, is 5%. And this is almost comes at no risk. So it's not like a stock market where you might get a year that goes way under and you might get another year that's way volatile and goes way high. So we're just going to go and pretend we're investing straight into a high yield savings account with our excess cash. And this is what I recommend everyone should do if they have excess cash lying around, because this is very liquid. You can easily just withdraw it when you need it. It takes like about just 3 to 4 days, but it's building a lot of interest on that. So say every month we only can contribute $500. Okay, so we're going to do 500 and we're just going to do per month. And we're going to compound this annually. It's fine. Let's calculate it. So there we go. So over the next 15 years, we'll have contributed a total of $90,000. But if you look at it, we get almost $40,000 just from interest. Now, what's insane is that, remember, this is money that you did nothing to do over the last 15 years. All you did was deposit your money and you left it into the high yield savings account at a 5% interest rate for the next 15 years. So now we can just kind of modify the numbers, and this is where it gets really fun and interesting. So let's pretend we do 20 years instead. It instantly jumps. So now you see we contribute this much, but instead of making less than half, now our interest goes even past 50% of our contribution. So let's play again and let's do 25. And we're getting even closer. So we're almost at like 80 or 90% our contribution rate. And then if we do 30, there we go. Then basically our interest rate is surpassed, or our total contribution is actually surpassed by interest rate. So what's crazy if you think about this is that you work to earn and only invest only $500 into this high yield savings account, or this investing, but your interest actually doubled what you put in. Now, this is only assuming we're just doing a high yield savings account. Now, if you go towards more riskier investments, they also offer higher rates of return, but of course there's more volatility and there's more risk. But risk doesn't always actually mean like you're gonna lose money and you're never gonna get it back. Risk just kind of means there's more volatility. But if you're investing for a long term, risk and volatility, especially with the dollar cost averaging strategy, is actually a good thing because you're going to be picking up the lows. Now, going back to this example, we're going to go towards the rate of return and we're going to hit the average stock market return, which is around, a lot of people like to be conservative and say 7 or 9%. But I think the stock market will continue to go on a high route. So let's just do 9%. And we can see here, let's go this back to 15 years. So there you go. Even in 15 years, with a 9% rate of return, we're seeing almost double. We're basically getting back our total contribution amount in the last 15 years. So if you're working and you only can contribute $500 a month, this is a very good example of seeing what you can do. Now, a good way to snowball and what I plan to do, because I actually invest more than half of my income. I live on a very low cost kind of life, and I always lived that way because my parents lived poor. And I'm used to that kind of life and I'm rather happy in it. But actually, I like planning for the future. So I would rather like sacrifice 10 of my years now. You can call it sacrificing. For me, it's not that much, but I'm going to sacrifice and invest for these 10 years just so I can give up, some happiness now, but in the future, I can have happiness for the rest of my life. So what I actually do, so I'm gonna input my numbers. And again, this isn't to show off or flex, because everyone is different. There are people who can invest more than me. There's people who invest less than me. But I invest $4,000 actually every month. So we put that in here. And you see that in 15 years, I easily, with just investing in the average stock market like VOO, I already go over $1 million in 15 years. However, I remember I promised you 10 years. It's actually more like 9 years now, because I'm already on my first year is already passed. So I only have 9 years left. So again, go ahead and play with this with your numbers and stuff like that and feel with it. But spend time with this to change the rate that you think you can do. Maybe you can aim for a higher rate of return. Maybe you can invest more money if you get another side job. You know, anything is possible. So I'm going ahead and input my exact progress on where I'm at right now. So I currently have invested $105,000. Now I only have 9 years left, because again, remember I already passed my first year. My rate of return. So this is where I get kind of risky, and this is only my personal risk tolerance. But I'm actually aiming for somewhere around a 21% rate of return. And if you remember my last example, what happened was the picture you saw was this. Compound quarterly. And that's the one that I showed on the screenshot here. But let's say we only compound annually, because that's more realistic. And I'm only have 9 years. So I'll leave this at 22. So this is more accurately like my progress, and I'll show you how I came up with these percentages and these numbers. I take a more volatile investing strategy, and I actually invest in one particular stock that I personally think will exceed even in the next 10 years. Now, when I reveal that stock, please don't think I'm telling everybody to invest in this stock. This stock is the best stock for me, because I'm personally a very tech major guy, and I believe in the next 10 years the stock market will continue to revolve around technology. Because if you think about it, where we are today and where we are in the next 10 years, I don't see any other place we would put our money and invest our money if it's not for technology. Like, recently with the new AI, bubble and the whole craze about AI technology, that was bound to come, because in the future I can imagine like flying cars, or like, even hopefully, but this is kind of, I don't know how they're going to do it, but hopefully teleporters in the future and stuff like that. That's where I believe the new generation will basically invest their money, if not anything else. Because if you think about technology, it makes our lives more enjoyable, more fun, more practical. When we have like teleporting around, and we don't have to go on an airplane to go across the world in the next like 20 hours. Imagine you can just teleport from the USA to like Japan, and during vacation, and just teleport back. Imagine like, stuff like that. Now, how it's possible, I don't know. I can't tell you yet. However, if you think about the convenience, if we made it possible, you can see that there would be a lot of people that invest their money around that. So that's why I really love technology. I grew up around computers, I learned how to fix and build my own computers, so that's just me. So I did mention we want to invest in ETFs. Now I mentioned ETFs because ETFs are a way safer, more diverse way to invest for the majority of the population. I chose an individual stock because this stock outperformed in the last 10 years and the last 20 years as well. And I believe it will continue to perform really, really well in the next 10 years. We're gonna look at the VOO's ETF composition. And you can see here, this is VOO, which is an ETF that tracks the S&P 500. You see at the very top, it's Apple. Now, spoiler alert, the stock that I invest in is basically mostly Apple. And the reason why I invest in Apple, don't take this as investment advice, but because in my generation, a lot of people use Apple products and the branding's everywhere. And not only that, it's other countries use Apple products too. And in my work environment, I still have younger generations. So I'm 30 years old, and I still have people who we hire who are only 18 and 19, and they still have AirPods. They still use Apple products. They have like, Apple Beats and everything. So I believe if my generation, use Apple when we were all like 20 years old, but now the next generation, 10 years down, are still using Apple, I believe in the next 10 years, Apple will be a very, very top of line individual company out there. So if we look at VOO, we're going back to here. Again, this is the S&P 500. If you remember, another one I looked at was VGT, which is the technology sector ETF of Vanguard. And you can see here, again, once again, you see Apple at the top. Okay. So as I mentioned, the other one, for beginners and starters. If you're barely getting yourself into the field of investing, you should stick to ETFs, and you only should buy individual stocks if you're confident enough and you've done enough research. Okay, so don't buy individual stocks before doing the research you need necessary to be able to invest in it. Like Warren Buffett once said, like when you invest in a stock, you must have done, enough research to even buy the stock in the first place. And after you buy it, you don't really have to look at the stock ticker anymore, because your research is just be like, hey, in the next 5 to 10 years, which was your investment horizon, it should have gone up, So you don't pay attention to the little nitty gritty, like little small downs or like, the next like news crash in the market. So looking through that again, we're going to look at this one. So this one's QQQM. Yep, QQQM up here. And again, once again, this one tracks the NASDAQ index. And once again, Apple's at the top. Now, Apple's not always at the top. Recently, like in the last, I think 2 months, Microsoft actually briefly surpassed Apple. And I think NVIDIA also surpassed Apple too. But, it's like basically goes on and off because, the stock price is always moving around. So Apple's once at the top again. So this next website that we're going to use is called AOI Lux. Now this one's currently free, and there's no, anyone can use currently. I don't know in the future if they're going to lock it down and make it like a paid subscription. But as of now, it is free. This one is extremely helpful website. I'm so glad I found this one. But what this one does is that it dollar cost average simulates what you would have done in the last, time span. So it uses past data and pretends like, let's say, 10 years ago, what if I dollar cost average into Apple, $4,000 every single month since 2014 all the way to 2024, and it gets you that result. Now again, past results aren't indicative of future returns. However, it tends to get the point across. You can see like, hey, if that worked that year, you can pick another year and say, hey, what if I did it from 2008 2018, and you can see kind of your results. So again, I want you guys to kind of play around with this. Spend a lot of time just like inputting like stocks that you like, or like S&P 500, VOO, and we try to like spit it out answers, and it kind of shows you like, it kind of wakes you up to how much money you can actually make by investing, and it doesn't really come at that much of a cost. So for my example, we're going to do Apple here. We're going to put 4,000 per month. So it's already on monthly. And then we're going to do 10 years. And then we're going to hit recalculate here. Okay. It's going to perform its magic, and then work its thing. So right here, it's going to pull us down to this graph. So look, it says takeaway, investing $4,000 every month from August 19th. So it takes the current date till now would generate this much gains. So that's not even your total position. Your total position is almost $1.9 million. Starting August 2024, if you did $4,000 every single month into Apple, you would have basically quadrupled your amount. So total wise, you can see the orange one is how much money you spent over the last 10 years. You spent almost $500,000 investing. It's $480,000 investing dollar cost average into Apple. But if you look at your total account value, it's literally quadrupled, almost quadrupled the amount that you invest in. So that's like 400% return, I think. Yeah, that would be a 4 times a 4 bagger. And this is like a 4 bagger without like lump sum investing. This is what I really like about this site, is that a lot of people think like, oh, if I invest back in 2014 and I just put, $500,000, I'm like, well, where are you going to get $500,000, right? It's not practical. For most investors, like, for most people like you and me, we invest on a, incremental amount. So we're looking to invest like $100 a month, or $100 a week, something like that. So this is why I love this site, because it uses dollar cost averaging, A lump sum is obviously, if you lump sum and put, $500,000 in an Apple at the very beginning, you're going to get a bigger return than this. But it's not practical. You're not going to be handed $500,000. And even if you were, you would probably spend that money. Let's be honest. You wouldn't invest that money. You probably would spend at least half of it on like fun things like Vegas or whatnot. So this one's a way more practical experience, Now again, this is Apple's, performance over there. You're like, oh, well, that's Apple. What if another one? Let's just try Microsoft, Microsoft was also big at the time. So again, 10 years, this is my investing amount, $4,000 per month. And you'll see here, if you pick stocks that you currently like, so if you look at Microsoft, almost the same exact, results as Apple, you get almost 300%, in the last 10 years. This site is really eye-opening for me. And it personally, like, I spent like when I first found this site, I spent like, I think like 6 hours, like 3 hours one night, and I stayed up, and then 3 hours the next morning, just like throwing in tickers that I knew. I knew like Nvidia. Oh, Nvidia obviously had the big spikes. If you throw in Nvidia here, it will extremely explode, you know. But again, we can't tell the future, because if you look at this, if we did on Nvidia, we would have had $22 million, you know. But that's because Nvidia had the AI spike, and then that's why the price is this. But in 2014, how would you have known that Nvidia was going to be the leadership in AI technology today, right? So, but it's very eye-opening how much money you can make if you just, you know, throw in numbers. So this is how I came up with my number. At first, I liked ETFs a lot more because they were more safer. But realizing how young I was and how much time I still have, I could still ride out the volatility by extending my, you know, investing horizon longer. Because some people, like maybe you only can invest for like the next 5 years, and then you have something big coming up like a marriage or something, right? So maybe your time horizon isn't so big. So when you take a shorter time horizon, there's a chance that you won't make as much money, or you will have to sell during a year that the market is down. So you always want to pay attention for something like that. So you see here, if I do 5 years, there's not enough snowballing going on. Now there's still snowballing, you know, like you would have invested almost $250,000, and in returns you would have got like, you know, a sixth of a million. But when you start investing in dollar cost averaging for a very long time, that's when the snowballing and a compound interest starts to work in your favor. So let's just go back to my example. My investing strategy for the next 10 years is dynamically dollar cost averaging into Apple, mostly Apple. Now on the side, I'm dollar costing into, like, you know, a very small amount into other stocks, but 90% or 80 or 90% of my investment is actually going to be in Apple stock. And I chose Apple because I chose to be more volatile, because I have a little bit more time and a little more leeway. Now, obviously, there's a chance that Apple underperforms and doesn't make as much as, let's say, QQM or something like that. But I'm willing to take the risk because I think there's a higher chance, and I have a longer time horizon for potential higher gains. And that's what I really ultimately want to have. So again, I'm going way over the, you know, average stock market of 9% per year. I'm trying to aim for a 20% per year return on my investment. You know, and I know, you know, a lot of people say like, oh, that's not realistic. Oh, that won't happen, you know. But again, if you play with this website and you see that, you know, you input like anything, it could be, what's another good one? Like Amazon, right? Like, let's pretend I invested, you know, all my money to Amazon in the last 10 years. I still would have got like a very good, I'd still be a millionaire, you know. Still would have got almost double my, or, you know, where is it? 200% on my returns right here. So it kind of basically puts the point across, you know, which, like, if you go around this website, I hope you get what I'm talking about. You kind of figure out like, okay, if I like this or I like that. Again, you don't have to dollar cost average, you know, all into one stock. I don't want you to do that. I want you to, you know, diversify, you know, dollar cost average in an ETF or 2 ETFs or something like that. Make sure that you do that, because, you know, if you start dollar costing average into a stock that you thought was going to do really well, and, you know, like pretend it's like Sears, or it's like one of those companies that actually went bankrupt, and you could have lost all your money and it would have been all for naught. So for investing and for beginners, I recommend you have, you know, ETFs into your portfolio, and have most of your portfolio as ETFs and not individual stocks. That's exactly how I invest my parents' money. I invest 80% of their, you know, investment into ETFs, and then the 20% I actually invest into Apple. So the last website that I heavily recommend that you guys try is the dividend calculator by MarketBeat. Now again, we're not actually investing in dividend, you know, ETFs or stocks. However, this website can do the same thing with any regular stocks, and it includes the profit and, you know, capital gain from dividends over time as well into the equation. So for me, it would be Apple here. Currently, I have 421 shares of Apple. You know. Now again, I said the next 10 years, but in reality, I'm actually, you know, it's gonna be the next 9 years, because I'm already past 1 year, so I only have 9 more years to go. And, you know, we're gonna change this to actually 8, because historically Apple did perform pretty well. This is the current share price and annual contribution. Now again, I invest per month, but if you turn it to an annual, it'll be $48,000 everything. Now the dividend tax rate in California, you do get state tax, so I'm actually going to raise this up to 24.3, because that's more of the tax bracket I'm in, given the, you know, 70K salary I have. Okay, And then we're gonna do 9 years invested. And the share appreciation. So this number, starts always at 3%. This is how much you expect the share of Apple to increase over the years. But remember, if we look over here, when we put in Apple, so this is how all three sides are gonna intertwine very neatly. So I'll show you how to get that number percent for the dividend calculator. If we invested $4,000 on a monthly basis since, right here, August 19th, 2014, all the way to now, we would have got this much portfolio. So what we try to do here is that we're going to go to this website. We're going to try to get this to equal basically what we got here. So this will kind of break down what kind of rate of return we're getting. What's tricky with this is you can say it's 28, but if you do compound quarterly, you'll see that it increases it a lot. So let's just say we have a quarterly income, because you'll see here on the dividend calculator, it has a distribution frequency of dividends of every quarter. So let's just match that and put this one as 1 quarter as well. And we'll do 24%, which I think exactly, there we go. So basically we're right on the thing. So right here, since we see that we got a 24% return, which what that means is that, every year our portfolio increased by actually 24%, which is bigger than the 20% that I'm going for. So we're gonna put right here 24. And then again, we're gonna go back to pretend like, this is my first year down. Now I'm on my second year. I have 9 years more to invest. And then we're gonna calculate dividends. And you see here at the very ending balance, we get something very similar. So this is how exactly it works, is that these all three can kind of get to the same matching point. This is how I plan to invest the next 9 years to become financially free. And if you scroll down, you can see basically, it kind of laid out for you when you start. So first year, obviously I already have this much, so I already start with that, how much dividends I get, how much money I put in every year. So obviously for next year, for next 10 years, I'm putting in the same amount of money. Now this isn't even accounting for the potential raises, and pay increases I'm getting. This number could be very well higher than what it's showing me right now. And at the end of the year, it tells you how many stocks you own and the current, average stock price. Now this price right here at the end of the year, surprisingly, remember, it's a range. This is assuming that, you're on a flat 24% increase per year. But the stock market, you'll have some years you don't make 24, you'll get like 18, and there'll be some years you get 30%, Surprisingly, last year when I did this simulation, I did it last year in June, I actually got a price that I actually hit today. So I'm basically even more confident to continue to invest. Back when I invested last year, Apple stock was around 183. And I put this and it said, oh, in the next year, the stock price would be at like 210 or 200, and I think it was like 220 or something. And then if you look at the current prices of Apple today, it actually hit that target of 24% gains in 1 year. So it's kind of insane that actually 24% is actually realistic. It's like, it's not too far off, because a lot of investors will tell you oh, you're gonna only average like 9%. But it depends on what you're investing in. And I like technology. I think technology is a category that will continue to excel, and excel faster than the average stock market, Because where else are we gonna invest our future money? It's not gonna be in consumer, communications. Is it gonna be in natural oil and stuff like that? Unless there's other breakthroughs in those industries, I believe the majority of the breakthroughs are gonna always be in technology. So, and right there, you see, that's how I plan to invest in the next 10 years. Investing, majority in Apple, and some of it elsewhere, but most of my investment strategy is gonna go to Apple. So there, and then let me go on my phone and prove basically how my portfolio looks like to you guys. Okay, go ahead and open the Webull app. It's gonna go to my homepage to sign me through. Okay, and the account that I'm using is individual cash account. So right here, if you look at my positions, you'll see the biggest one there is Apple. There you go, 421 shares. Basically $95,000 in my portfolio. So out of all the cash I'm holding, only $20,000 is not in Apple. It's sitting on the side. I have over here, I have $14,000 sitting as a cash balance, and then that means there's only $6,000 in other stocks. But there's $95,000 into Apple right there. Now the other stocks you might see in my portfolio are just some stocks that I used to originally plan to invest on, but as I kind of did more research and did more findings, I decided that I would actually be more happy if I concentrated more in my portfolio on Apple instead of diversify, because I believe in Apple's company more than I believe in, let's say Visa or MasterCard. Like, I believe Apple company will return higher yields than the other stocks. So you see, I'm going for more risk, but again, I'm going for potentially higher returns as well. You see, other stocks that I like right there. So if you look at my recurring, let's go to orders. We go to investment orders. So you see, I only have 3 current orders. I have one on GameStop, and this one's just, a very small amount just to play and try to see if I can get the next kind of GameStop surge. But other than that, it doesn't really mean anything. I have Nvidia because I believe AI a little bit of it, so I'm putting $60 right there into Nvidia every week. If you scroll down, you'll see Apple right there. I'm putting in around $630 currently for Apple. Now generally I put in more than this per week, but I'm only lowering it now because I have to save enough money so I can have the wedding paid for. I'm having a wedding in October, and I have to make sure we save enough money for the venue and for everything. So I'm currently had to lower my investing amount. But later, if you look at here, I can just click on Apple. I can just modify it. So you can see the initial, history of Apple and how much I've been buying. If you scroll down here, it shows you exactly how long I've been buying Apple. So this is proof right here that I'm just dollar cost averaging. In this case, it's dynamic dollar cost averaging into Apple for the last year. So if we keep scrolling, you'll see I've been doing it all the way since last June. So over here, you'll see I dollar cost even more. There are some days where right here, you see the $800, buy of Apple. This is when Apple started to actually decline and dip down really low. And this, since I was on a dynamic dollar cost averaging strategy, it started to pick up even more Apple shares. So I was able to get a lot of Apple shares on a low price, which overall lowers my average price on Apple. But again, this is just me revealing my investing strategy. I'm not a financial advisor. I'm not telling everyone to invest in Apple. I'm just letting you know this is what I do. You need to do your own due diligence and do your own research and which ones you want to invest in. But like my last video mentioned, I recommend investing in ETFs. And as you slowly do more research and get more confident as you're investing and you become a better investor, that's when you can kind of, section your portfolio out and do more investing towards, individual companies that you personally believe will invest. Because let me tell you something, you shouldn't invest in other companies that other people tell you to, because the moment it has a price dip or something, you don't have the financial confidence to stay with the dip. So a lot of people, when they invest and they hear hey, just buy Bitcoin or buy something like that, and there's a big old dip, they don't know anything about it and they're just more scared about it. But for me, when I see an Apple dip, I've done my research. I've done I'm confident to stand by them even during the dip. And instead of selling, I maybe just, hold my investments, or I might even buy more, Take responsibility into your own investing decisions, okay? Over the last year, you can see there are actually some reds on this graph, and this is when Apple's gone down. I remember last year when I started investing, there were years where I was oh, I'm up. When I started, I was oh, I'm up $2,000, great. And then there'll be times where it goes from $2,000 up all the way back down to minus $3,000 losses. So I'm oh my God, I'm sitting at an overall loss. And remember, I trusted the system, I trusted the whole thing, and sooner or later it bounced back up to another positive 4,000 up again. I was oh, I'm even higher than last time, if you follow the graph. And then dropped from $4,000 up back down to $4,000 down. So you can imagine the roller coaster. So as you see, after the last $4,000 down, it's only been up from there. And then from the 83 price that it was stuck at for the longest time, Apple finally broke broke all the barriers, went all the way up to 235, and then now it's hovering around 235, and then we got a little bit dip. That's because Warren Buffett sold more around half of his stake, but the reason wasn't because he didn't trust Apple, is that he believes there might be more corporate tax in the future, and he wants to lock in some of the gains now before the corporate tax takes over, and then he would have to pay more taxes to the government, because the financial debt is in a very it's in a big crisis over there. So you can see even after that dip, it's Apple continues to go back up. And throughout all this time, I don't even sell. Another question I ask myself all the time is do you see the stock still around the next 10 years? And if so, are they doing good? Are they doing better? Or are they doing worse? And for me, the stock that I chose, I believe will be definitely there in the next 10 years. And remember, I still could be wrong, but I believe it. And I believe it'll do really, really well. You see my money weighted return. So right now, if you compare it to all the indexes down here, you can see how well you're doing against, the Dow Jones, the S&P 500, and NASDAQ on Webull, So this is money weighted. So money weighted returns account for, when you put the money into the stock market. It doesn't make, it doesn't compare against a whole lump sum investment, which is what I really like. So right now, the portfolio I chose, which is majority Apple, is outperforming the NASDAQ, which is awesome. So I hope you guys learned a lot from that. Again, I'm not a financial advisor, and this is not financial advice. This is my review on my investment strategy for the next 9 years, and how I plan to be financially free, and maybe sell Apple then, and maybe invest in more dividend stocks like SCHD, and just live off of dividend income. How awesome would that be? Where in 40 years, if you think about it, oh, you're working really hard and you're not really enjoying life for the next 10 years. But the way I see it is that when I'm 40 all the way till I'm 80, and the next 40 years after those 10 years, I get to live however I want. My dividends will supply my lifestyle. My stocks will continue to appreciate. I have investments coming in. One day I can just wake up and it's hey, I want to eat a lobster today. Or hey, I want to go skydiving today. Or hey, I want to go visit Italy. It could be anything, because you already have the financial restraints broken away. You're not really chained down because your job, you have to go locate and work at your job. Because once you live this way, it seems way more freeing. It just seems like you can do anything you want, and then you don't have to worry about oh, I need to do this to pay the bills, I need to do that to help my kids, I need to fund them a college credit. One of the biggest reasons that got me into investing too was that before, initially, I actually didn't want to have kids in the future, because I was very pessimistic about the outcome of the world. I don't want to raise kids in a generation that's more difficult than mine. I felt guilty of doing that. But now, with investing and with my wife, I kind of changed my view set, and we do plan to have kids. And I'm confident enough that I can actually financially afford the kids and, assist them through a more difficult life with my financial ability, which in the past I was not confident in. Again, remember 6 years ago, I was almost nowhere. And then today, 6 years later out, I'm I got everything kind of figured out, and I hope you guys learned something from this video, and you guys can also get to that stage where life isn't so bad, and you can see the light at the end of the tunnel, and you just, work through it because you have a goal in mind. If you made it this far, please do me a big favor and like and subscribe to the video. What that does, it will help other people find my videos so that they can maybe get the help and assistance that they need in life. Again, I'm making these videos because I really want to help the people out there who may be struggling like I was, and then they're trying to put it all together, but life might seem too difficult. And then I finally found a way out, and I find my achievements, and now I'm enjoying life while I'm still working hard to be financially free in the future. Stay tuned, guys, to my next video where I will show you exactly why I started my YouTube channel. And until then, guys, I hope you guys have a great one. Again, always stay humble, always hustle, and you'll soon be on the journey to financial freedom like me. Until then, I'll see you guys in the next one.